If you're retired and receiving Social Security, let me ask you an important question. When you hear that benefits are increasing in 2026, will that number you see in the headlines actually match what lands in your bank account each month? For many seniors, the answer is no, and that gap between what you expect and what you actually receive is where confusion and stress begin. In this video, we're slowing everything down. We're breaking apart the increase, the deductions, and the quiet rules that reshape your check behind the scenes. Not what looks good on paper, but what really shows up in real life. The 2026 Social Security increase. Why headlines don't tell the full story. Right now, millions of retirees are hearing the same message. Social Security benefits are increasing in 2026. After years of rising prices for food, housing, and healthcare, that sounds like relief. Any increase feels reassuring when you're living on a fixed income. But here's what most headlines don't explain clearly. The announced increase is only the starting point. It is not the final amount you take home. It is not the number that ends up in your bank account. Some seniors will see a meaningful improvement that lasts. Others will notice only a small change. And some will be left wondering why the raise they were promised barely shows up at all. What makes 2026 different is not one dramatic change. It's several smaller changes happening at the same time. Benefits are being adjusted, deductions are shifting, income rules are interacting quietly in the background. When these pieces collide, the result can look very different from one retiree to the next, even for people with similar work histories. This is where frustration often begins, not because the system is broken, but because the full picture is rarely shown up front. Once you understand how these layers work together, the confusion starts to fade and the numbers begin to make sense. Before we go further, let me ask you, do you expect your Social Security check to go up in 2026, or are you unsure what will really change? Comment expecting more, not sure, or already confused. Your comment helps others see they're not alone. The cost of living adjustment, how much more money? Is it really? The increase everyone is talking about for 2026 comes from one source, the cost of living adjustment, often called COLA. Yes, the Social Security Administration has confirmed it. Benefits are going up. But here's where expectations and reality start to drift apart. COLA is announced as a percentage, and percentages sound impressive. 3%, 4%. Those numbers feel significant, especially when inflation has been squeezing budgets for years. But percentages don't pay bills. Dollars do. When that percentage is translated into actual monthly income, the increase is modest for most retirees. In many cases, it works out to tens of dollars per month, not hundreds. That doesn't mean the increase is meaningless. Every dollar matters on a fixed income, but it does mean expectations need to be realistic. Many seniors feel disappointed not because Social Security made a mistake, but because they expected the increase to change their lifestyle. Instead, it often helps cover only a small portion of rising costs, a grocery trip, part of a utility bill, or part of a prescription. Another important detail often gets overlooked. COLA is calculated using a formula designed to track inflation broadly. It does not reflect each retiree's personal expenses. Medical costs, housing, and insurance often rise faster than the index used for COLA. So while benefits do increase, many seniors still feel financially tight. Understanding this early helps prevent frustration later. The increase is real, but it was never designed to be dramatic. It's meant to help benefits keep pace, not leap ahead. Why the 2026 increase is a gross number, not what you take home. One of the most important details about the 2026 Social Security increase is also one of the least explained. The number you hear announced is a gross increase. That means it's calculated before anything is taken out. Before your benefit reaches your bank account, several other factors step in quietly and reshape the final amount. And this is where many seniors feel confused. On paper, your benefit goes up, but what actually arrives may look very different. The Social Security system works in layers. The increase is applied first, then deductions are processed. Only after that does the final amount get deposited. This is why two people can hear the same announcement and walk away with very different reactions. One feels relief because their net amount increases enough to notice. Another feels frustration because their take-home pay barely changes. Usually nothing went wrong. No one was misled. The increase wasn't reversed. The system simply did what it's designed to do. The problem is that most explanations stop at the headline number. They don't show what happens next. Understanding that the increase is gross, not net, changes how you interpret everything that follows. It explains why expectations often don't match reality, and it prepares you for the next pieces of the puzzle that matter even more. Once you see Social Security as a process rather than a single number, the experience feels less personal and less confusing. And that clarity is essential as we move deeper into what really shapes your 2026 check. How Medicare Part B premiums can absorb much of your increase. For most seniors, one factor has more influence on their Social Security check than almost anything else in 2026. That factor is Medicare Part B. For the majority of retirees, Medicare Part B premiums are automatically deducted from Social Security. You don't receive a bill, you don't approve the charge. The deduction simply happens before your benefit reaches your bank account. And in 2026, those premiums are not staying the same. For many people, Medicare Part B costs are rising again. That means a portion of the Social Security increase you hear about never actually reaches you. Here's how the sequence works. First, Social Security applies the COLA increase to your benefit. Then Medicare Part B premiums are deducted, so even though your benefit is technically higher, your take-home amount may increase by far less than expected. In some cases, the Medicare increase absorbs a large share of the raise. In others, it nearly cancels it out. This is one of the biggest reasons the 2026 increase feels so different from person to person. Two retirees hear the same announcement. One feels relief, the other feels confused or disappointed. Nothing went wrong, no one was singled out. The system simply applied two changes at the same time, one raising benefits, the other raising healthcare costs. Once you understand that Medicare operates quietly in the background, the math becomes clearer, and that clarity helps explain why the headline number and your bank deposit rarely match. Why the age? You claimed Social Security still matters in 2026. One of the most misunderstood parts of Social Security is this. The decision you made years ago about when to claim still affects your check today. And in 2026, that effect becomes even more noticeable. If you claimed Social Security before your full retirement age, your benefit was permanently reduced. That reduction didn't disappear over time. It became the base on which every future adjustment is built, including the 2026 increase. That means each cost of living adjustment is applied to a smaller starting number. If you claimed at your full retirement age, your base benefit was higher. As a result, the same percentage increase in 2026 produces a larger dollar increase. And if you delayed claiming beyond full retirement age, delayed retirement credits increased your benefit even more. Every adjustment now applies to a larger amount, compounding the difference over time. This explains something that frustrates many retirees. Two people can have similar careers, similar earnings, and similar work histories, yet see very different results from the same 2026 increase. The system isn't favoring one person over another. It's following formulas that were locked in the moment benefits were claimed. And this is important to say clearly. Claiming early was not a mistake. It was a decision based on health, finances, and life circumstances at the time. What matters now is understanding how that decision continues to shape your income, so you can plan forward with clarity instead of second-guessing the past. Working while collecting Social Security. The rule. Many seniors misunderstand. For many seniors, Social Security is not their only source of income in 2026. Some continue working part-time. Others take short-term or seasonal jobs, and many do so while already collecting Social Security. This is where confusion often begins. Earning income does not automatically stop your Social Security benefits. But if you have not yet reached full retirement age, there is an annual earnings limit. If your income goes above that limit, Social Security temporarily withholds part of your benefit. When this happens, it can feel alarming. Monthly checks get smaller. Some seniors think they've done something wrong. Others worry they've permanently damaged their future benefits. But here's the key point many people don't realize. Those withheld benefits are not lost. Once you reach full retirement age, Social Security recalculates your benefit. The money that was withheld is gradually returned to you through higher monthly payments. The real issue is not the rule itself. It's not knowing the rule exists. Without that understanding, some seniors avoid work they could safely do. Others earn just enough to trigger reductions without planning for the temporary cash flow change. And there's an important turning point. Once you reach full retirement age, the earnings limit disappears completely. You can work as much as you want, earn as much as you want, and your Social Security continues at the full amount. For many retirees, that flexibility becomes a major source of relief and an opportunity to strengthen their financial stability in 2026 and beyond. How taxes quietly reduce your Social Security check in 2026. For many seniors, taxes are the last thing they expect to affect their Social Security income. After all, you paid into the system for decades, so it feels reasonable to assume that your monthly benefit arrives tax-free. But in 2026, taxes remain one of the quietest and most surprising factors reshaping Social Security checks. Yes, Social Security benefits can be taxed. The key is something called combined income. This includes your adjusted gross income, certain interest income, and half of your Social Security benefits. When that total crosses specific thresholds, up to 85% of your Social Security benefit can become taxable income. This is where many seniors feel blindsided. That does not mean you lose 85% of your benefit. It means that portion is counted when calculating your federal income taxes. Still, the impact feels real. In some cases, even a modest Social Security increase in 2026 is enough to push combined income over a threshold. Suddenly, more of your benefit is taxed, and the raise feels smaller than expected. This situation is especially common for retirees who are taking withdrawals from traditional retirement accounts like IRAs or 401ks. Those withdrawals stack on top of Social Security and raise combined income quickly. The result isn't a mistake. It's a rule quietly doing its job. Understanding how taxes interact with Social Security allows you to plan withdrawals more carefully and avoid unnecessary surprises when your check arrives. Why retirement account withdrawals can increase your Social Security taxes. For many retirees, Social Security is only one piece of their income picture. They also rely on withdrawals from traditional retirement accounts like IRAs and 401ks to cover everyday expenses. And on the surface, that seems straightforward. But in 2026, this combination is one of the most common reasons Social Security checks feel smaller than expected. Here's why. Withdrawals from traditional retirement accounts count as taxable income. When you add those withdrawals on top of Social Security, your combined income rises, often faster than people realize. Once combined income crosses certain thresholds, more of your Social Security benefit becomes taxable. In some cases, that increase is enough to push up to 85% of your benefit into the taxable category. Again, this does not mean you lose your Social Security. It means more of it is included when calculating your taxes. But the timing matters. Many seniors increase retirement account withdrawals to keep up with higher living costs. Then Social Security increases through COLA. Together, those two changes can quietly push income into a higher tax zone. The result is frustrating. On paper, Social Security went up. In reality, taxes rise alongside it. This is especially confusing because the tax impact doesn't show up immediately in your monthly check. It often appears later when you file taxes, making the increase feel misleading in hindsight. Understanding how retirement withdrawals interact with Social Security helps explain why the 2026 increase feels smaller for so many people and why planning matters more than the headline number suggests. Is Social Security really running out of money? Separating headlines from reality. Few headlines create more anxiety among seniors than this one. Social Security is running out of money. It's a phrase that gets repeated often and rarely explained carefully. So let's slow this down. Current projections show that if nothing changes, Social Security trust fund reserves could be depleted sometime in the mid-2030s. That statement alone sounds alarming, but it's usually missing the most important context. Depletion does not mean Social Security disappears. It does not mean checks suddenly stop. What it means is that once reserves are used up, benefits would be paid using ongoing payroll tax revenue. Based on today's estimates, that revenue would likely cover roughly 3/4 of scheduled benefits. That's a reduction, yes, but it's very different from zero. History also matters here. Social Security has faced funding challenges before, and each time changes were gradual, not sudden. Lawmakers have consistently prioritized protecting people who were already retired or close to retirement. That's why many experts believe any future adjustments are more likely to affect younger workers than current seniors. For retirees receiving benefits in 2026, there is no indication of an immediate threat to monthly payments. Understanding this distinction is critical. Fear grows when headlines are vague, confidence grows when facts are clear. And the fact is this: while long-term planning is necessary, Social Security in 2026 remains a functioning system, not one on the verge of collapse. Why contacting Social Security has become harder, and why that matters in 2026. Another quiet but important issue shaping the Social Security experience in 2026 has nothing to do with benefit formulas or tax rules. It has to do with access. For many seniors, contacting the Social Security Administration has become noticeably more difficult. Long phone wait times, fewer in-person appointments, and limited staffing mean that even small issues can take much longer to resolve. In the past, a missing document or a simple correction might have been handled quickly. Today, those same issues can stretch on for weeks, sometimes longer. This matters because Social Security is not optional income. For millions of retirees, it is the foundation of their monthly budget. When access is limited, delays feel heavier, unanswered questions feel more urgent, and small uncertainties can turn into ongoing stress. That's why being proactive matters more in 2026 than it did before. Keeping copies of benefit notices, Medicare statements, and correspondence can make a real difference. Tracking dates, names, and confirmation numbers helps protect you if follow-up is needed. This doesn't mean the system is broken, it means the system is stretched. Understanding that reality allows you to adjust your approach, not by panicking, but by preparing. Seniors who stay organized and informed are often better positioned to resolve issues, even in a slower system. In today's environment, protecting your Social Security income isn't just about understanding the rules, it's also about knowing how to navigate access when you need it. Why the 2026 increase feels so different from one retiree to another. By this point, one thing should be clear. There is no single Social Security experience in 2026. Two retirees can hear the same announcement about an increase and walk away with completely different outcomes and very different emotions. That's because Social Security is not adjusted in isolation. Your claiming age matters, your Medicare premiums matter, your tax situation matters, your work income matters. Each of these factors interacts with the others, quietly shaping what actually arrives in your bank account. For one retiree, the 2026 increase may feel like genuine relief. Their Medicare costs stay relatively stable, their taxes don't change, and the additional income helps cover rising expenses. For another, the experience feels disappointing. A higher Medicare premium absorbs much of the increase. A tax threshold is crossed, or part-time income temporarily reduces monthly checks. On paper, both benefits increased. In real life, the results look nothing alike. This is why comparisons between retirees often lead to frustration. Your neighbor's check going up doesn't mean yours will rise the same way, and feeling disappointed doesn't mean something went wrong. It usually means the system applied the rules differently based on individual circumstances. Once this is understood, reactions begin to change. Confusion gives way to clarity. Frustration gives way to planning. The 2026 increase is real, but its impact depends entirely on how your personal situation fits into the larger system, not on the headline alone. Turning understanding into control. Why clarity reduces financial stress. For many retirees, the hardest part of Social Security isn't the math, it's the uncertainty. Not knowing why a check changed, not knowing whether a reduction is permanent, not knowing what will happen next year. This is where understanding becomes powerful. When you understand how Social Security works, how increases are calculated, how deductions are applied, and how income rules interact, the system stops feeling random, the numbers stop feeling personal, and the stress begins to ease. Clarity creates control. Instead of reacting emotionally to headlines, you start asking practical questions. How much of my increase is offset by Medicare? Will this raise change my tax situation? Does my work income affect my check now or later? These questions don't require complicated financial tools. They require awareness, and awareness leads to better decisions. Retirees who understand their benefits are more confident adjusting retirement account withdrawals, accepting part-time work, or planning for healthcare costs. They're less likely to panic over short-term changes and more likely to see the bigger picture. Control doesn't mean eliminating uncertainty completely. It means replacing fear with facts. In 2026, Social Security hasn't suddenly changed its purpose. It's still applying the same rules it always has. The difference is whether you see those rules clearly. When you do, Social Security becomes less of a mystery and more of a manageable part of your financial life. Common misconceptions about Social Security that create unnecessary worry. A large part of the stress surrounding Social Security in 2026 doesn't come from the system itself. It comes from misunderstandings. Over time, certain ideas get repeated so often that they start to feel true, even when they're incomplete or incorrect. One common misconception is that if your Social Security check doesn't increase much, something must have gone wrong. In reality, Medicare premiums, taxes, or income rules may simply be absorbing part of the increase. Another misunderstanding is that working while collecting Social Security permanently damages your benefits. For most people, especially those below full retirement age, reductions tied to earnings are temporary, not permanent. Taxes cause confusion as well. When seniors hear that up to 85% of Social Security can be taxed, many assume they're losing most of their benefit. They're not. That percentage refers to how much of the benefit is included in taxable income, not how much disappears. There's also fear around claiming decisions. Some retirees believe claiming early ruined their future income, but claiming early was a choice made with the information, health, and finances available at the time. The system isn't punishing that choice, it's simply applying consistent formulas. These misconceptions don't just create worry, they change behavior. People avoid work they could safely do, they delay planning, they second-guess decisions that can't be undone. Understanding what Social Security actually does and what it doesn't do removes much of that unnecessary fear. And when fear fades, confidence takes its place. What seniors should focus on now to protect their 2026 income. By the time all the changes for 2026 are considered together, one message becomes clear. Social Security works best for seniors who stay informed, organized, and realistic. This doesn't mean tracking every headline or worrying about every rumor. It means focusing on the areas that actually shape what you receive each month. First, focus on your net benefit, not the announced increase. Understanding what remains after Medicare premiums and taxes gives you a realistic picture of your monthly income. Second, pay attention to how other income sources interact with Social Security. Part-time work, retirement account withdrawals, and interest income can quietly change your tax situation or temporarily affect your checks. Third, stay organized. Keep records of benefit statements, Medicare notices, and any communication with Social Security. In a system where access can be slow, documentation is protection. Fourth, review your situation regularly. What worked last year may not work the same way in 2026. Small adjustments, like timing withdrawals differently or planning work hours, can prevent unpleasant surprises. Finally, don't underestimate the value of understanding. You don't need to master every rule, but knowing the basics gives you confidence, and confidence reduces stress. Social Security was designed to provide stability. When you understand how it fits into your overall financial picture, it can still do exactly that, even in a changing environment. The real bottom line, what your 2026 Social Security check truly means. When everything is put together, the story of Social Security in 2026 becomes much clearer. Yes, benefits are increasing, and for many seniors, that increase is real. But the number that matters most is not the one in the headline. It's the number that actually reaches your bank account after Medicare premiums, taxes, and income rules have quietly done their work. That's why the experience feels so different from one retiree to another. Nothing is broken. Nothing is being taken away without reason. And nothing about 2026 represents a sudden shift in how Social Security works. What's happening is layered. An increase is applied. Healthcare costs adjust. Taxes interact with income. Past decisions continue to shape today's outcomes. When these layers aren't explained together, frustration fills the gap. But when they are, something important happens. Understanding replaces worry. This income wasn't a gift. You earned it over decades of work, and you deserve clarity about what's really coming, not just reassurance, but confidence. In 2026, the seniors who feel most secure won't necessarily be the ones with the biggest increases. They'll be the ones who understand how their benefits work, what affects them, and how to plan without fear. Understanding creates control. Control reduces stress, and that peace of mind is just as valuable as any increase. That's the real message behind your 2026 Social Security check, and it's one worth holding on to long after the headlines fade.